Well, I think central banks will have a very difficult next few quarters. To be honest, for most of the last 2 or 3 decades, central banks have had a relatively easy task because every time we've come up with a crisis or a problem, they have been free to ease policy considerably because most of the inflation forces exogenously were downward, so they could kind of ease against that kind of downward disinflationary pressure. The problem that they have now is that a lot of the exogenous forces at the moment are inflationary. You know, whether it's supply chains, whether it's stimulus, etc. A lot of the exogenous forces are inflationary at the moment. So it makes central banks' job a lot more difficult going forward. And to be honest, it probably raises the risk of a policy error. Now, the problem is we don't know which way that policy error is. Is it to do too much, i.e. to keep stimulus going for too long, or is it to try to tighten policy with all the inflation around and risk choking off the recovery? So the risk of a policy error is definitely getting higher at the moment.
Jim, it's a really interesting point that we don't exactly know which direction that policy error could be in at this point. Talking to equity investors over the last 24 hours or so, the message to me seems to be, where does the 10-year U.S. Treasury yield go from here? That seems to be the number one question for equity investors to understand where to go, how to position. So what's your take, quite simply? Where do you see the U.S. 10-year going?
We see the yields going higher. To be fair, we have done all through summer, and the summer months were bad for that view. We think the summer was heavily influenced by technicals in the Treasury market. The Treasury wasn't issuing very much, and QE was massively taking up all the supply of Treasuries. That technical is starting to normalise now, and obviously with QE ending, the technical should go the other way to some degree. So we think yields will go higher. And when you throw in the inflation into the mix, that supports our view. So our year-end target for 10-year Treasuries as a house is about 1.8% now, but it probably continues to go higher into 22.
Jim, in your morning note this morning, which I think is a staple read for many around London, you mentioned how many are increasingly talking, and the world, and the world. You talk about how increasingly people are talking about stagflation. Do you think that is a real risk at this stage, given that we're looking at rising prices, supply chain disruptions, and potentially a slowing economy, especially coming out of China?
Yeah, and I think it's a valid concern. We still got to get through COVID. I mean, obviously, we are still in a COVID wave. So, next year, when COVID hopefully is more behind us, some of the growth problems might ease, some of the inflation problems might ease. But I think we'll be left with higher inflation at the back end of it. And I suppose the risk is that growth is a bit weaker than we expect. I still think next year will be okay from the growth point of view because there's a huge amount of stimulus in the system. Obviously, beyond that stimulus, then obviously we might get back to the same problems we had before the crisis of pretty challenging growth conditions. But I would still say for the moment that there's enough stimulus in the system that next year's growth will be okay. But I do think it will be with higher inflation.